Realty Income is a real estate investment trust that primarily focuses on owning and leasing commercial properties, particularly retail and commercial real estate. It generates income by leasing properties to various tenants under long-term lease agreements, often with built-in rent escalations. Realty Income is known for its consistent dividend payments and is often referred to as the monthly dividend company, because it pays dividends on a monthly basis to its shareholders. Just like the entire REIT sector, Realty Income has been down significantly this year, with the stock seeing a decrease of over 20% year to date. Looking at the longer time frame, the company is down over 8% in the last 5 years, but this is of course without including dividends. Realty Income is liked by many investors because of their solid starting yield, that is currently sitting at over 6%, and the monthly dividend payments giving investors a steady stream of income throughout the year. Let's move over to our QuantView stock insight tool to get a broader insight into how Realty Income is performing. As we can see here, the revenue has been going up very nicely over the past 10 years, with very consistent growth every single year and a big increase in the past few years. This is a recurring trend we can see in the EBITDA and the funds from operations as well. Their AFFO per share has been a bit flat here and there, but isn't an uptrend in general. This is caused by Realty Income diluting shareholders to acquire more property, which is nothing out of the ordinary in the REIT sector. This is something that we can see in their gross property, where it has been growing significantly after the pandemic. Realty Income also increases their dividends every single quarter by a small percentage, and this causes them to have a 5-year average growth rate that is sitting at just under 3%. This is, however, something we'll talk more about in the next segment of today's video. And by the way, if you want to get access to this stock insight tool and all of the valuation models that we will be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investment journey. And with that out of the way, in today's video we will be taking a 3-step approach to thoroughly evaluate Realty Income and determine its fair value. Step 1. Margin of safety. In this step, we'll assess Realty Income's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into Realty Income's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as funds from operations and dividend discount model to gain insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Realty Income as an investment opportunity. To determine this final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we are using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first 2 metrics that we'll be looking at are the margin and EBIT growth. As we can see, the EBIT has gone up significantly over the years, going from just under $400 million in 2013, going to over $1.3 billion in 2022. The average EBIT growth during this period has been sitting at 15%, which is a 5% deduction in a margin of safety. If you look at the margin, it has actually gone down over the years, going from 51% in 2013 to 39% in 2022. The average margin decline during this period has been sitting at 4%, which is in the red part of our scale, indicating a 5% increase in a margin of safety. The next metrics that we'll be looking at are the dividend growth and debt to EBITDA. The dividends have gone up very nicely for Realty Income, going from $2.20 a share in 2014 to $3 in 2023. The average dividend growth is sitting at 3.6%, which is in the orange part of our scale, indicating no change in the margin of safety on this metric. To determine our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Realty Income, this is over 5 years, in this case a 550% debt to EBITDA ratio, which is in the red part of our scale, indicating yet another 5% increase in the margin of safety. And the final 2 metrics that we'll be looking at are the occupancy rate and rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. As we can see, 99% of Realty Income's properties are currently occupied and only 1% is vacant and not generating any rent. This is a very good ratio, as it is in the bright green part of a scale, indicating a 5% deduction in a margin of safety. Rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. As you can see in the top right, the rent margin has gone down for one single year in 2021, but it has managed to regain itself a little bit in 2022. But in general, it's in a downtrend. This causes the rent margin to still be up 1% because of this massive dip in 2021 and it recovering. But this is no change in a margin of safety, as it's in the orange part of our scale. It's looking alright so far for Realty Income, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to FFO mean reversion. Price to FFO, or funds from operations, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric used for REITs, as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average, and if the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued, and is expected to revert to its mean over time. We've imported the share price of Realty Income and the FFO per share come from 2016 to 2022. The average price to FFO during this period has been sitting at 19.32, and doing the same with the trailing 12 months data, we get a price to FFO of 12.27, indicating that's undervalued by a significant margin, and this gives us a price per share of this model of $78.65, which is an upside of almost 57.5%. The second model we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividend payments to determine the fair value of its stock. It assumes that the intrinsic value of the REIT is the sum of all expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by the REIT's dividends, and that future dividends are a crucial factor in determining the stock's worth. We've imported the dividend payments of Realty Income going from 2018 to 2022. The average growth rate in the dividends during this period has been sitting at 2.57%, and I'm projecting all of their future dividends to grow by 3%. I'll be using a discount rate of 8.5% in this valuation. This gives us an intrinsic value of this model of $56.37, which is an upside of almost 13%. And the last model that we'll be using are the AFFO multiples. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, we've imported the price to AFFO of two similar companies to Realty Income, and this gives us an average price to AFFO in the industry then of 14.54. While the price to AFFO of Realty Income is sitting at only 12.60, indicating that's undervalued on this metric, and this gives us a multiple valuation price per share of $57.63, which is an upside of over 15%. Now that we've gone through all of the valuation models, let's go look at the final overview of a valuation next. Coming to our final overview, we've imported the price to FFO, discounted dividend, and the AFFO multiple valuation, giving us an average of $64.22. On margin of safety, we've determined earlier, using a standard margin of safety of 25%, deducting 5% for the EBIT growth and the occupancy rate, and adding 5% for the margin growth and the debt to EBITDA, leaving us with the same 25% margin of safety that we started with. And applying this margin of safety, we get a fair value of $51.37. And with the current price of $49.94, we get an upside of almost 3%, indicating that per our valuation, it is currently a hold. Now, if you want to get access to all of the valuation models that I used in this video and all of my other videos, you can check in the description for my Patreon link, and you'll also get access to the QuantView Stock Insight tool that we've recently released. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.